A Vanguard S&P 500 index fund and a Vanguard S&P 500 ETF hold the exact same 500 companies. So why does one trade like a stock and the other doesn't? These three terms trip up almost everyone opening their first brokerage account, and the confusion makes sense because the financial industry uses them inconsistently. Sometimes index fund describes what's inside the package. Sometimes it describes the package itself. Sometimes a mutual fund is an index fund. Sometimes an ETF is an index fund. The whole system feels designed to confuse you, but there's actually a simple logic underneath. Once you understand that we're talking about two completely different questions, what you're buying and how it's wrapped, let's define the terms clearly. An index fund is any fund that tracks a market index by holding all or most of the securities in that index in the same proportions. The S&P 500, the total stock market, bonds, real estate, whatever the index covers, the fund copies it automatically. No human stock picker deciding Apple is better than Microsoft. Just pure replication. That's the recipe. A mutual fund is a legal wrapper. It's a pooled investment vehicle that collects money from many investors, buys a portfolio of securities, and calculates its price once per day after markets close. That price is called net asset value, or NAV. When you buy shares of a mutual fund, you're buying directly from the fund company at that end-of-day price. When you sell back to the fund company at whatever the next closing price turns out to be. Mutual funds have been around since the 1920s. An ETF, or exchange-traded fund, is a newer legal wrapper that launched in the 1990s. It also holds a basket of securities, but instead of trading directly with the fund company, you buy and sell shares on a stock exchange throughout the day, just like buying shares of Apple or Tesla. The price fluctuates minute by minute based on supply and demand, though it usually stays very close to the value of the underlying holdings. You buy from another investor through a broker, not from the fund company itself. Here's the key insight. Both mutual funds and ETFs can hold index portfolios, and both can hold actively managed portfolios. The Vanguard Total Stock Market Index Fund is a mutual fund that tracks an index. The Vanguard Total Stock Market ETF tracks the exact same index but trades on an exchange. Fidelity has actively managed mutual funds where humans pick stocks. RK has actively managed ETFs where humans pick stocks. The wrapper and the contents are independent choices. So how do the mechanics actually differ? Let's walk through what happens when you invest. With a mutual fund, you place an order anytime during the day. Maybe you click buy at 10 a.m., maybe at 3 p.m. Doesn't matter. The fund company queues up your order and executes it at 4 p.m. Eastern, when markets close, using that single daily NAV price. If the fund's total holdings are worth $50 million and there are 1 million shares outstanding, the NAV is $50 per share. You pay exactly that, no more, no less. If you're buying through a brokerage instead of directly from the fund company, some brokers charge transaction fees for mutual funds, typically $10 to $75 per trade, though many major brokers have eliminated these fees for a large menu of funds. With an ETF, you place an order just like buying a stock. You see a live price, maybe $50.02 at this second, $50.01 5 seconds later. You can use limit orders, stop orders, trade during lunch, trade at 9:31 a.m., whatever the stock market allows. Your broker charges the same commission they charge for stock trades. At most major brokers today, that's $0 for standard orders. The price you pay isn't the exact NAV. It's whatever another investor is willing to sell for at that moment. But competition between traders keeps the price extremely close to the value of the underlying assets, usually within a few pennies for popular ETFs. Now let's talk about costs beyond the buy and sell transaction. Both mutual funds and ETFs charge an expense ratio, which is an annual percentage fee taken from the fund's assets to cover management, administration, and overhead. This fee is invisible in your account. You never see a bill, but it reduces your returns automatically every day. A fund with a 0.20% expense ratio deducts $20 per year for every $10,000 you have invested. Index funds, whether wrapped as mutual funds or ETFs, tend to have very low expense ratios because there's no expensive human research team. Many charge between 0.03% and 0.20%. Actively managed funds, in either wrapper, typically charge 0.50% to 1.50% or more because humans cost money. Here's where people get tripped up. Some mutual funds also charge loads, which are sales commissions paid to brokers or advisors. A front-end load of 5% means if you invest $10,000, only $9,500 actually goes into the fund. A back-end load charges you when you sell. No-load mutual funds skip this entirely. ETFs never have loads because you're buying from another investor, not from a salesperson. But ETFs do have a hidden cost that mutual funds generally don't: the bid-ask spread. That's the gap between what buyers are willing to pay and what sellers are asking. For a popular ETF like one tracking the S&P 500, the spread might be just 1 cent on a $400 share price. Negligible. For niche or low-volume ETFs, spreads can be 10 or 20 cents or more, effectively adding a small cost every time you trade. Then there's taxes, and this is where ETF structure has a genuine advantage for taxable accounts. When investors sell mutual fund shares back to the fund company, the fund sometimes has to sell underlying stocks to raise cash for the redemption. Those sales can generate capital gains, which get distributed to all remaining shareholders, who then owe taxes even if they didn't sell anything themselves. ETFs avoid most of this through something called the in-kind creation and redemption process. Big institutional investors can exchange baskets of the actual stocks for ETF shares, or vice versa. So the ETF rarely has to sell holdings and trigger gains. For the average investor, this just means ETFs tend to distribute fewer taxable capital gains each year. In tax-advantaged accounts like 401ks and IRAs, this advantage disappears because you're not paying taxes on gains annually anyway. One of the biggest misconceptions is that index funds are always cheaper than actively managed funds. That's usually true, but index fund doesn't automatically mean low cost. Some mutual fund companies offer index mutual funds with expense ratios below 0.05%. Others offer index mutual funds with ratios above 0.50% and front-end loads on top. The index strategy is cheap to run, but the wrapper and the company's pricing can add layers of cost. Similarly, not all ETFs are index funds, and not all are cheap. Niche ETFs that use complex strategies or hold illiquid assets can charge 0.75% or more. Another confusion point: people assume ETFs are always better because they trade live. But if you're a long-term investor adding money monthly, intraday pricing is irrelevant. You're not trying to time the market minute by minute. The mutual fund's end-of-day pricing works perfectly fine and removes the temptation to watch the ticker. Conversely, if you want the ability to trade midday or use limit orders, the mutual fund structure physically can't do that. The wrapper matters depending on how you plan to interact with it. One edge case worth mentioning: some 401k plans only offer mutual funds, not ETFs, because the plan's record-keeping systems were built around end-of-day pricing. Other plans offer both. At some fund companies, the mutual fund version and ETF version of the same index portfolio have slightly different expense ratios. Sometimes the ETF is a few basis points cheaper, sometimes they're identical. You have to check the specific fund's documents. Also, many brokers let you buy mutual funds in any dollar amount, even fractional dollars, because the fund company handles the math. ETFs require buying whole shares unless your broker specifically offers fractional ETF shares, which some now do, but not all. Here's the summary. Index funds describe what's inside a portfolio that tracks a market index. Mutual funds and ETFs describe the wrapper, how you buy, sell, and hold that portfolio. A mutual fund trades once daily at net asset value directly with the fund company. An ETF trades continuously on an exchange at live market prices between investors. Both charge expense ratios. Mutual funds sometimes add loads and trigger more capital gains distributions. ETFs sometimes add bid-ask spreads, but usually defer taxes better. The contents can be identical. The cost and tax treatment depend on the structure and the specific fund's choices. When someone says just buy an index fund, they almost always mean a low-cost fund tracking a broad index, but they haven't told you whether it's wrapped as a mutual fund or ETF. Now you know the wrappers are different packages around the same core idea, and which package matters depends on where you're buying, how often you're trading, and whether your account is taxable.